Imagine a patient whose arteries are quietly clogging. They feel perfectly fine until one day, the blood simply stops flowing. According to billionaire investor Ray Dalio, the U.S. economy is that patient, and the plaque restricting our system is over $1 trillion in annual interest payments. Dalio warns that our financial system is officially past the point of no return.
Yeah, that is quite the hook.
I mean, it sets the stage perfectly. Because today, we are exploring a perfect storm brewing in the global economy, specifically focusing on the highly vulnerable window between 2026 and 2028. We are unpacking Ray Dalio's chilling warning that the United States is currently facing a collision of massive historical forces.
Right, and we have a lot to get through to make sense of that.
Exactly. So to do this, we are pulling from a really incredible stack of sources. We've got a variety of macroeconomic reports, a recent Bloomberg television interview with Ray Dalio, and several institutional analyses detailing both the artificial intelligence equity bubble and this whole new world of geopolitical finance. Welcome to Deep Cuts and Deep Thinking.
Thanks for having me. And, it is vital to state right up front that while Dalio's warnings sound, utterly apocalyptic, the goal of this deep dive isn't to induce panic. You shouldn't walk away from this feeling helpless.
No, definitely not.
Right. Our objective is to give you the actual analytical tools to understand why these massive macroeconomic forces are converging right now, the underlying mechanics of how they operate, and ultimately what that means for your financial reality over the next few years.
Yeah, let's start by translating that medical analogy of clogged arteries into the raw present-day numbers. Because when you look at fiscal year 2026, the United States government is spending roughly $7.4 trillion.
Which is a massive number on its own.
Huge. But it is only bringing in about $5.6 trillion in tax revenue. That leaves us with a staggering structural deficit of $1.9 trillion. I mean, that is 5.8% of the entire U.S. gross domestic product is running in the red during a time of relative economic peace.
Yeah, the sheer size of that $1.9 trillion is troubling, for sure. But the actual danger, it lies in the mathematical mechanics of what we call a debt systolic cycle.
A debt systolic cycle. Okay, what is that exactly?
So it's a specific threshold where the average nominal interest rate the government pays on its debt becomes higher than the nominal growth rate of the economy itself.
Oh, wow. So the interest is growing faster than the actual economy.
Exactly. And when an economy hits that tipping point, the debt starts compounding autonomously. A government becomes trapped in this loop where it is forced to issue massive amounts of new debt simply to pay the interest on the old debt. To put that in perspective, over half of our current deficit, meaning $1.06 trillion, is literally just net interest outlays.
Wait, if I'm understanding the mechanics here, it sounds like a corporate leverage buyout where the core product is no longer selling. You have a company that has taken on massive loans to operate, but instead of using revenue to invest in new products or like better facilities, all the incoming cash is just servicing the interest on the loans.
That's spot on.
Eventually, the debt just consumes the entire cash flow of the business.
Yeah, the leverage buyout comparison captures the mechanical trap perfectly. And the way out of that trap is incredibly restricted today. Like after World War II, the United States had a massive debt burden, sure.
Right, but it was different then.
Very different. The government possessed the demographic flexibility to essentially cut its way out of it while riding a wave of massive population growth. But today, mandatory entitlements like Social Security and Medicare make up 2/3 of all non-interest government spending.
And we can't exactly just cut those.
No, because of the aging demographic curve of the country, those costs are structurally locked in. They cannot simply be slashed without causing a pretty catastrophic domestic crisis.
Okay, let's unpack this. It's like using a high-interest credit card to pay off the minimum balance of another high-interest credit card, but on a national scale. But if the math is this obviously broken, why do we keep making it worse? What about the One Big Beautiful Bill Act of July 4th, 2025?
Ah, yes. Well, the One Big Beautiful Bill Act is a perfect example of this political paralysis. The act basically made a bunch of temporary tax cuts permanent.
Right, and there's a big debate about whether that was the right move.
Exactly. To be completely objective here, you have two very different institutional viewpoints. On one side, the Council of Economic Advisors argues that making those cuts permanent was necessary to prevent a massive tax cliff, which they say would have crushed domestic investment. Okay,
but what's the other side saying?
Well, the Congressional Budget Office ran the numbers, and they estimate that extending those provisions will increase the 10-year deficit by $4.5 trillion. So you have one side focused on economic growth, and the other side pointing at this massive structural hole being blown into the budget.
Man, they're both looking at the exact same bomb, just arguing passionately over which wire to cut.
And that political paralysis you're describing is the core reason the problem is migrating. Because the fiscal side of the government cannot or will not resolve the math, the burden of managing this entire debt spiral is being shoved directly onto the central bank.
So the Fed has to deal with it.
Yeah, the government is essentially handing a ticking time bomb to the Federal Reserve, which sets up a massive institutional showdown. Analysts are currently referring to this as the Worsh test.
The Worsh test. Named after the incoming Fed chair, Kevin Worsh. Right.
Exactly. It's the impossible policy dilemma facing him in the summer of 2026.
Let's break down this Worsh test. What are the actual options on the table for him?
Chair Worsh is really facing two mutually exclusive paths. Option number one is to appease the global bond vigilantes. This means raising interest rates to fight inflation and loudly declaring the Fed's absolute independence from the government.
But didn't we just establish that raising rates blows up the budget?
That is the exact mechanical problem. Raising rates dramatically increases the borrowing costs on $39 trillion of national debt, which crushes the federal budget instantly. So then you have option number two, which is for the Fed to accommodate the fiscal authority by stepping into the open market, buying treasuries, and artificially capping the yield on government bonds to keep borrowing costs low.
But capping yields artificially, isn't there a historical precedent for that? Did we do that before?
We did. It is a strategy called financial repression, and it was heavily utilized from 1945 to 1980. The mechanics of financial repression are, well, quite elegant from a government's perspective.
Elegant how?
The central bank forces nominal bond yields to stay below the actual rate of inflation. So say inflation is running at 6%, right? But the Fed caps the bond yield at 4%. That creates a negative real interest rate of 2%. Over a decade or more, this quietly liquidates the real value of the national debt.
If the government forces interest rates to stay lower than inflation, doesn't that just mean a stealth tax on the savings and retirement accounts of everyone listening?
What's fascinating here is that, yes, it operates entirely as a stealth tax. Financial repression is a direct wealth transfer from the creditor, meaning everyday savers, pension funds, and bondholders, to the debtor.
Which is the federal government.
Exactly. Your purchasing power is systematically eroded year after year to balance the national ledger.
But why on earth would global investors or, everyday citizens just sit there and accept that erosion of their wealth?
Historically, they tolerated it because of strict capital controls. In the 1940s and 50s, the government essentially trapped money inside the domestic banking system. But that highlights the massive modern challenge for the Fed today.
Because money moves so easily now.
Exactly. We exist in an era of seamless global capital mobility. If we look at the leading indicators of institutional capital flow, investors do not have to accept the stealth tax. With the click of a button, they can move billions of dollars out of U.S. treasuries and into hard assets, commodities, or foreign jurisdictions.
And if they do that, what happens?
When that capital flees the currency, it severely drives down the value of the U.S. dollar, making imported goods drastically more expensive. And that risks sparking a stagflationary spiral.
Which brings up a really confusing contradiction. The bond market is clearly suffocating under this mountain of debt. But if you look over at the technology sector, companies are spending money like it is literally infinite.
Oh, it's wild.
We are seeing these massive tech valuations that seem incredibly fragile, especially if the Fed is forced to hike interest rates to stop capital flight. So where is all this money going?
The scale of the capital expenditure in technology right now is truly historic. To anchor this in reality, the big four hyperscalers are pumping an estimated $650 billion into artificial intelligence infrastructure this year alone.
$650 billion just on AI infrastructure.
Yes. And that is a staggering jump from the $410 billion they spent in 2025.
Here's where it gets really interesting. But wait, isn't AI actually a miracle technology that will boost productivity? How can it be a bubble if the underlying tech is real?
That is the core debate. And it requires applying Ray Dalio's bubble framework to understand what we are really looking at. Because transformative technology and massive financial bubbles, historically, they go hand in hand.
Like when?
Look at the 1873 railroad mania. The railroads were entirely real, right? And they radically revolutionized human transport and commerce. But the speculative financial boom surrounding them still wiped out massive amounts of wealth when the underlying economics didn't immediately support the valuations.
Oh, sure. Same with the internet in the 90s.
The dot-com crash of 2000 was identical. Buying the stock of an AI company today is a bet on a financial valuation 10 years in the future, not just an endorsement that the technology exists.
Because I read a recent report from MIT saying that 95% of enterprise AI pilots actually fail to deliver measurable returns. So what exactly are these hyperscalers buying with $650 billion? I struggle to get an AI chatbot to accurately summarize a simple recipe for me without hallucinating ingredients, but we are building a multi-trillion-dollar infrastructure for it.
Yeah, the disconnect is huge. Right now, these tech giants are locked into a dynamic that macro strategists refer to as the CapEx trap. It is a classic game-theoretic Nash equilibrium.
Let's unpack the mechanics of that Nash equilibrium. How does that game theory actually play out in a boardroom?
Think of it as a multi-billion-dollar prisoner's dilemma. These tech CEOs are terrified of losing their competitive edge in a winner-take-all market. If one CEO decides to be, fiscally responsible and pause their massive spending on compute infrastructure, the market will immediately punish their stock.
Because investors will assume they are falling behind in the AI race.
Precisely. Therefore, they are all forced to keep spending billions upon billions of dollars to maintain market share, even though they know the immediate economic returns on that hardware are terrible. They are trapped into destroying long-term capital just to survive the short-term narrative.
So they are incredibly rich on paper, but cash poor in terms of actual realized AI profits.
And that distinction between paper wealth and liquid money is the pin that bricks the bubble. Paper wealth is just concentrated equity valuation driven by market sentiment. Money is liquid, spendable currency. Because the economy's actual cash buffers are incredibly small relative to these multi-trillion-dollar tech valuations, a problem arises when sentiment shifts. If interest rates spike and investors suddenly need actual money to cover margin calls, everyone tries to convert their paper wealth into cash at the exact same time.
There just isn't enough cash to go around.
Exactly. The exits are simply too small, which triggers a systemic liquidation cascade, destroying trillions in paper wealth almost overnight.
And what could actually trigger that rush for the exits? Because this brings us to a terrifying vulnerability. The tech giants can't build a $2 trillion infrastructure out of thin air. They need physical, advanced microchips. And the United States government needs foreign buyers to absorb its mountain of debt.
And both of those massive vulnerabilities rely entirely on international geopolitics holding together, which brings us to the global capital war.
Right, the weaponization of the U.S. dollar.
Yes. For decades, the U.S. enjoyed the structural advantage of the dollar being the world's unquestioned reserve currency. Global trade, especially oil, was settled in dollars, creating massive automatic demand for our currency. But recently, the U.S. has weaponized that dominance, utilizing the SWIFT payment system to freeze foreign reserves and enforce sanctions.
And obviously, other countries are going to look for workarounds to avoid that risk, which is where we see the rise of systems like BRICS Pay and the Decentralized Cross-Border Messaging System, or DCMS. How do these new systems mechanically threaten the dollar?
Well, the legacy SWIFT system operates like a hub-and-spoke model. If money moves from point A to point B, it generally has to pass through a centralized hub, which gives the U.S. oversight and the ability to block transactions. DCMS and BRICS Pay operate on decentralized ledger technology.
So they just bypass the hub entirely.
They allow two countries to settle bilateral trade directly in their local currencies without routing it through a centralized hub. There is no central switch the U.S. can turn off. By adopting these systems, global economies actively reduce the structural transaction demand for the U.S. dollar right at the exact moment the Treasury desperately needs to sell record amounts of debt.
And that financial fracturing is happening alongside what the sources call a military fiscal asymmetry. The U.S. is facing rising external military commitments, but our ability to actually finance a massive defense expansion is entirely crippled by that $1.06 trillion interest bill we discussed earlier. We literally cannot afford a Cold War, let alone a hot one.
That fiscal vulnerability brings us to the ultimate physical choke point in this entire system, which is Taiwan. The concentration of global risk resting on that single island is almost impossible to overstate.
Because of the microchips.
Yes, the Taiwan Semiconductor Manufacturing Company, TSMC, produces roughly 92% of the world's advanced logic semiconductors. These are the specific nanometer-scale chips required to train advanced AI models, to build modern automotive microcontrollers, and to power next-generation defense systems.
It sounds like the global economy is a massive, incredibly heavy Jenga tower built on debt, and Taiwan is the single load-bearing block at the very bottom.
The Jenga analogy works, but think of it more like Taiwan is a hyper-specialized, impregnable vault that holds the entire global economy's combination code. If you lock that vault, everything stops.
Wow, okay. Let's look at the mechanics of a shock. What happens?
If a naval or digital blockade of Taiwan begins at midnight, by noon the next day, the global supply chain realizes no new nth chips are coming. The ripple effects are instantaneous. Global tech revenues crater because companies can no longer produce their hardware.
Just off a cliff.
Current estimates suggest a blockade would trigger a tech sector equity crash that destroys between $5 trillion to $10 trillion in global value within weeks. Beyond the stock market, the physical halt in manufacturing would shrink global GDP by 5% to 10%, plunging the world into a severe, immediate recession.
But how does a shock to Taiwan actually feed back into the U.S. debt spiral? I mean, how are those connected?
By cutting off 92% of the world's advanced chips, you instantly create massive global hardware inflation. The price of anything containing a microchip, from cars to medical equipment to cell phones, would skyrocket overnight.
Oh, and the Fed has to fight inflation.
Exactly. To fight that sudden, explosive inflation, the Federal Reserve would be forced to drastically raise interest rates. And as we established when discussing the debt systolic cycle, raising rates when the government is already sitting on $39 trillion of debt immediately triggers a catastrophic default or forces the Fed into hyperprinting.
It is a terrifying closed-loop system. A geopolitical shock pricks the AI bubble, which spikes inflation, which forces rate hikes, which blows up the national debt. So what does this all mean? As we actively enter this 2026 to 2028 window, how do we practically navigate this? Let's bring these massive macroeconomic concepts down to earth for you, the listener.
Ray Dalio's framework maps out a convergence of 5 major macro forces, and they are all colliding right as the U.S. navigates the 2026 midterm elections and the 2028 presidential cycle. This period guarantees intense political polarization, paralyzing the government's ability to enact any meaningful structural reform.
So no one is coming to save us from a policy line.
Exactly. And because the government is paralyzed, institutional allocators are not waiting around. They are actively implementing portfolio immunization strategies right now.
Okay, what does the mechanics of portfolio immunization actually look like for an institution?
It means a deliberate structural transition away from highly concentrated nominal G7 long assets. Institutions are actively reducing their exposure to those incredibly expensive AI tech megacaps, and they are abandoning long-duration government bonds that offer fixed yields.
Because of the inflation risk.
Right. Instead, they are moving toward hard cash flow resilient assets. For instance, there is a massive shift out of standard nominal treasuries and into treasury inflation-protected securities, commonly known as TIPS.
Why TIPS specifically? How do they protect against that stealth tax we talked about earlier?
Well, TPS are mechanically designed so that their principal value adjusts based on the consumer price index. If the government implements financial repression and lets inflation run hot to liquidate the national debt, the principal value of a TPS bond adjusts upward to match that inflation, offering direct mechanical protection against unexpected spikes in consumer prices.
Okay, that makes a lot of sense. The sources also emphasize looking outward. It's not just what you hold, but where you hold it, right?
Jurisdictional diversification is a huge theme right now. Capital is moving into fiscally disciplined or strategically neutral jurisdictions. Switzerland is a primary target.
Oh, really? Why Switzerland?
Because it has a constitutional debt break rule that legally forces the government to balance its budget over a business cycle, preventing the kind of debt spiral the U.S. is facing entirely. Singapore is another major destination, acting as a robust, highly capitalized financial hub that is insulated from G7 geopolitical overextension.
What about the oldest hedge in human history? Does physical gold still play a role in the digital economy?
It plays a surprisingly foundational role. The institutional analyses indicate allocators should consider an increased structural allocation of 10% to 15% in physical gold.
10% to 15%, that's not insignificant.
Not at all. The mechanics of why gold matters right now are entirely tied to the capital war we discussed. Gold acts as a non-sanctionable neutral reserve asset. It exists completely outside the SWIFT system or the DCMS networks. You do not need another party to fulfill an obligation for gold to have value.
Right. Central banks globally have already realized this and are acting on it. Gold currently makes up 17% to 20% of all global central bank reserves as they actively diversify away from US dollar dependence. So when we pull all this together, what does this actually mean for you, the listener? Dalio, using the phrase point of no return, sounds incredibly dire. But it doesn't mean the world actually ends tomorrow.
No, absolutely not.
It simply means the old rules of the economic game, the era of low inflation, infinite debt-fueled tech growth, and unquestioned dominance of the US dollar are effectively over. The board has been flipped. To protect your wealth in this new window, you need to deeply understand the new mechanics of financial repression, critical importance of hard assets, and why jurisdictional diversification matters more than ever.
And that shift in the rules of the game raises a vital question, and it is a final thought to mull over as we conclude today's deep dive. If every major superpower on the planet is simultaneously trying to quietly inflate away their massive domestic debts, and if fiat currencies are increasingly being weaponized in geopolitical conflicts, we have to ask ourselves a fundamental question about value. In a decade, when the dust from this convergence finally settles, what will the global economy decide is the ultimate, unquestionable measure of true wealth?
If you found this podcast interesting, please like and subscribe. Thank you for joining us today.